Before we start this video, do like and subscribe to our channel and not miss on any updates.
The next we'll do is Accounting Standard 13. Again, very, very important standard which deals with investment. There are only 2 or 3 types of questions which are regularly tested in the examination. And if you are comfortable with that, we will be able to handle this. Now, first thing, what is investment as per AS 13? These are assets held by an enterprise. So they are an asset for earning income by dividends, interest, or rentals, or for capital appreciation or other benefits. So you are holding it for earning income, that is largely in the nature of dividend, interest, and rentals, or for capital appreciation or other benefits. Now, typically, when we say investment, that is covered by Accounting Standard 13, is your investment in equity shares, bonds, debentures, investment in property. Okay. Now, what are exclusions? If something is held as stock in trade, it is excluded. Means if I'm buying and selling investments regularly as stock in trade, I'll exclude that. Accounting Standard 19 covered, operating or finance leases, those are excluded. Investments or retirement benefit plan of life insurance and life insurance enterprise, that is removed. And venture capital funds and related AMC or unincorporated mutual funds, etc., those are also excluded. Okay, these are what are excluded from the scope of this particular standard. Now, definition is not that much relevant, but what is important is what are the types of investment. The standard describes or classifies the investment into 2 categories: current investment and long-term investment. Current investment is intended to be held not more than 1 year from the date of investment, and it is readily realizable. So basically, we also can call it short-term. Less than 1 year you can call, less than 12 months you can call, but this is not from the date of investment. You are viewing it from the date of investment. I will hold it for a period of 12 months, current investment. If it is not a current investment, we classify it as a long-term investment. So there are 2 types of investment: current investment and long-term investment. Current investment, that is your something which is intended to be held for not more than 1 year from the date of investment and which is readily realizable. Long-term investment is any investment other than a current investment. If it is not current, it has to be long-term. Now, the key part of this standard, what it also requires is, if it is current investment, we will show it at lower of cost or fair value. If it is long-term investment, we'll show it only at cost. That will come subsequently, but this is the overall principle when it comes to classification of investment. Now, how do we account for investment? Initial recognition is always done at cost. Initial recognition means first time when you recognize something, you will consider it to be at cost only. The cost of an investment includes acquisition charges. So what is that? Whatever amount you have paid plus brokerage fees, duties is not, but it's stamp duty or something like that. Okay, so that is what you will consider. So if I have paid, let us say 1,000 is the cost, 1% is the brokerage, which is 10. So my cost of investment becomes 1,010. Cost of investment becomes 1,010. Okay, then we have this discussion of cum interest and ex interest that we will do subsequently. Cost will include this, plus if you have brokerage, you have considered if there is any fees, any duties, whatever is paid to acquire the investment forms part of the cost of investment. If, however, we have acquired it by issuing shares or other securities, then the cost is fair value of securities issued or asset given. So if I have acquired an investment by issuing my own shares, or if I have acquired an investment by giving some other asset, then I will take asset, security issued or asset given. Always first preference will be something which is given, unless something which what you have given up is considered first. If you are acquired in exchange or part exchange for another asset, cost of investment is determined with reference to fair value of asset given up. Again, here also fair value of asset given up. But if something which is acquired is more evident, then we will take that. Same principles what we learned in Accounting Standard 10, Accounting Standard 26, same principle applied here. Fair value of asset given up. If acquired is more evident, then fair value of asset acquired. More evident means it is more clear. It is more clear. That is what is cost. Now, we said that there is a requirement of fair value. What is fair value? is the amount for which an asset could be exchanged between a knowledgeable willing buyer and a knowledgeable willing seller in an arm's length transaction. So generally, this fair value, what we can refer to is at market value. Typically, you can look at stock exchanges. Whatever is happening in the stock exchanges, whatever is being dealt with at the stock exchanges, that is what is the fair value. Okay. That is what we will use. Now, whenever we buy an investment, for example, I have purchased some shares or I have invested in debentures, I have invested in bonds, I will receive for shares dividend, for other investments interest. Now, if this dividend pertain to the pre-acquisition period, we'll deduct it from the cost of investment. For example, I acquired something on 1st of April of 25. The company declared dividend for the year ending 31st March of 24. This is declared out of pre-acquisition profit. So if something is declared out of pre-acquisition profit or it is related to pre-acquisition period, we will reduce it from the cost of investment. Whatever is for the post-acquisition period, we'll take it to P&L. So if I have invested 10,000 in a particular share or in a particular security, and I have received a dividend of 1,000, which is pre-acquisition, this will be shown at a value of 9,000. This adjustment is relevant for accounting standard 21 questions as well, what we have discussed there. Okay, so 10,000 minus 1,000, 9,000 is the amount that will show the investment. Now, how about interest? Interest, what happens is, let us say, I purchased some securities on 1st of June of 25 and last interest paid was on 31st of March of 25. I have 1,000 debentures of 100 each at 12% interest. So the debentures pays me 12% interest. 1,000 is the number, 100 is the face value, 12 is the interest. So I purchased on last interest paid. Last interest paid was on 31st of March. Next interest will be paid on 30th of June of 25. Next interest will be paid on 30th of June of 25. Now, 31st of March of 25, whatever is the interest I have paid or the company has paid, it is okay. On this date, I have bought. Now, when I bought on this date and when I get interest on 30th of June, I will get interest for 3 months. I'll get interest for 3 months. Though I have bought on 1st of June, on this date, because I hold the debentures, I will get the interest for 3 months. Now the seller will say, boss, for April and May, I have held the investment. So you have to reimburse that interest to me. So generally what happens is, I'll calculate interest for 2 months. That is 1,000 into 100 into 12% into 2 divided by 12. If I do that, 12% of 100 is 12. So 12, this gets cancelled. Interest is 2,000. This is called pre-acquisition period interest. So when I am buying the debentures from the other party, he would say amount you have to pay is 1,000 into 100 plus 2,000, that is 1,02,000. When I pay this 1,02,000, 2,000 is for the interest, 1,00,000 is for the debenture. So this 2,000, what I will do is I will debit investment by 1,00,000. I will debit interest receivable by 2,000 and I'll credit bank by 1,02,000. Now, if you see on a face value basis, face value is 100. Number of months from last interest paid is 2. Interest rate is 12%. Now, how much interest has been accrued on this 100? Interest is equal to 100 into 12% into 2 by 12. So this will be 2. The other party, when he sells me, he will say pay 102. This includes interest. Or we say this is cum interest, that is cumulative of interest. Now, even if the question does not say we have paid interest or not, we have to calculate that interest component. We have to calculate that interest component and account for it appropriately. So any interest for the pre-acquisition period will not be taken to the cost of acquisition. It will be considered as a part of your P&L item. Okay. Now, if I say 102, come interest. Interest is 2. So 100 is X interest. 100 is X interest. Brokerage is calculated on 102 only. Brokerage is calculated on 102. This is taken to investment account. This is taken to the interest account. Okay. Now, the complex part of these questions we'll deal with it subsequently. But are you clear with the come interest portion and the X interest component, how to calculate? Likewise, when we acquire right shares can be acquired on come rights basis inside entitlement. So when we acquire shares and we are entitled to rights, what happens is we can subscribe to the rights shares subsequently. Okay. Now, if we have subscribed to the rights shares, means the company has come up with a rights issue, we have subscribed to it, the cost of the rights share is added to the carrying amount of original holding. So if the company comes up with rights shares, we have subscribed it, the cost will be added to the original holding. That's straightforward. But if we have not subscribed, but we have sold it in the open market, so I can sell my right entitlement in the open market. I can sell right entitlement in the open market. Then the proceeds will be taken to the P&L. But there is an exception. For example, I have acquired some shares at 100 on come rights basis. I have sold the right entitlement for 5. Typically, this 5 should be taken to P&L, no problem. But if the share price falls because of this rights issue and X rights price, let us say, becomes 96. X rights price became how much? 96. Then what will happen? Then what you will do? To the extent of this 100 minus 96, 4, you will reduce from cost of investment, and 1 you will take it to P&L. Sir, what if X rights falls to 94? Entire 5 will be adjusted from the cost of investment. So if shares are acquired on come right basis and the market value of the investment immediately after the becoming X right is lower than the cost for which they were acquired, sale proceeds of rights will be applied to reduce the carrying amount of such investment to the market value. So from 100 it became 96. 4 out of this 5, 4 will be credited to investment account and balance 1 will be taken to P&L. This is one concept which is important, can be tested on MCQ basis, or when you're doing MCQ, you will do it. Okay. Then, as far as investments are concerned, it is lower of cost or fair value. It is lower of cost and fair value. And if it is long-term investment, it is carried at cost. Principle. Theory, very important. When you get a theory question, you have to write long-term investments are carried at cost. Current investments are carried at lower of cost and fair value. Now, if cost is 100, fair value is 90, you will record it at 90. This 10 of loss is taken to P&L. So if reduction in fair value is debited to P&L account. If reduction is done, it will be taken to P&L account. Okay. Then subsequently, let us say in year 2, fair value became 105. Cost is 100. So what you will do? You will value it at cost. Now this 90 to 100, the reversal, if the investment value is increased, the increase up to the cost is credited to P&L. So because 10 we have debited to P&L, 90 when it became 100, this 10 we will credit to P&L, like this we will do. And we will do on each investment individually. It is not that you will take gold, silver, debentures, bond, everything on one side and compare it on a totality basis. That is not allowed. Gold, do it separately. Silver, do it separately. Each share, each instrument separately we have to value. So formula, current investment is valued at lower of cost or fair value. If there is a reduction in fair value, it is debited to P&L. If there is subsequent reversal, it is credited to P&L up to the cost. You will not show it above the cost. For long-term investment, they are carried at cost, and very important that if there is any decline which is other than temporary, for remembering purpose, you can put it permanent, but you have to say other than temporary. If there is an other than temporary decline in the carrying amount of long-term investment, the reduction in carrying amount is charged to P&L. So if cost is 1000, if Cost is 1000. Because of reduction, it came down to 900. 100 will be debited to P&L. If subsequently we feel that the whatever the decline was there, which has been removed, then in that case, what you will do? You will reverse the amount back to the P&L. Okay. Again, it is done on individual basis. Then there is something called as investment property. Investment property is basically your land and building held for investment purpose. An investment property is an investment in land and building that are not intended to be occupied substantially for use in the operation of the enterprise. So if I have an office place building, if I'm using it for my office, I call it to be property, plant and equipment as per accounting standard 10. But I have a land and building and I want to give that on rent, then that is called investment property. That is called investment property. Investment property is accounted by using the cost model as per accounting standard 10. So you'll have cost minus depreciation minus impairment. Okay, so that is about investment property. Whenever we sell off investment, the difference between the sale proceeds minus selling expense and the carrying amount is to be taken to P&L. So basically, I can say net sale value. Let us say 1000 is the sale value, 1% brokerage. So you will do minus 10, you get 990. The sale value will compare with the carrying amount. Sale value will compare with the carrying amount. If sale value is greater than the carrying amount, the difference is taken to P&L. If it is the reverse case, you will debit it to P&L. So gain is credited to P&L and the loss is debited to P&L. Okay. When the part of investment is disposed, let us say I have 1000 shares, but I have disposed only 500 shares, then we will calculate the average carrying amount, using the average carrying amount basis. So basically we'll do average basis. We'll do the average basis. This, when we solve questions, we'll have more clarity. Sometimes there can be reclassification. Earlier we thought it is current, now it is long term, possible. Or it was long term, now it is current. What we will do? We will do first, if it is current to long term, means current to long term, lower of cost or fair value. So you will take cost, fair value on the date of reclassification, whichever is lower at that value, you will take it to long-term investment. And subsequently, that amount becomes the cost for the long-term investment purpose. Okay. If it is long-term to current, means earlier it was long-term, now it is current, you will take lower of cost or carrying amount. Carrying amount generally happens if there is a permanent amount deduction or otherwise it is cost. So lower of cost or fair value, lower of cost or carrying amount. In these two, that is how you will do the reclassification. The difference that will be taken to PL. Difference will be taken to long-term investment in A is costing 8.5 lakhs are now classified as current. Company had reduced the value of this investment to 6.5 to recognize a permanent decline. Fair value is 6.8. But you will take cost and carrying amount, not the fair value. Cost and carrying amount, whichever is lower. So 6.5, that is how you will take. Okay. Now, this is the portion covered by accounting standard 13. In the next class, we will see how do we do the accounting, how do we prepare the accounting, do the accounting for investment, how do we prepare the ledgers, what are the things to be taken care, all of those things. Okay. Tomorrow, there is no class. The next class is on 26th. We will do from 10 to 12 or 12:30. Okay. Sure. Thank you.
Okay. So in the previous class, we ran through the discussions around accounting standard 13 investment, what is the principle. Now today what we'll do is we'll take up the questions which are generally tested in the examination. So there are two types of question. One question will test about the accounting standard 13 principle. For example, cost or net realizable value, not net fair value, cost or fair value, long-term investment. That is one type of question. And then the second type of question is where we have to prepare a ledger account for investment. So one is where they'll test the core principles of accounting standard 13. How do you value current investment? How do you value long-term investment? These principles are tested. Then we have second type of question where they will ask you to prepare investment account in the books of the investor. These are the two type of question that generally comes up. These principles we have already discussed. Now in examination, when you get a question, whether it is current investment valuation or long-term investment valuation, you have to give the definition of what is a current investment or a long-term investment. Then what is the valuation principle? For example, what you would say, long-term investment. These are generally valued at cost, unless there is a decline which is other than temporary. So if there is a decline which is other than temporary, then we will write it down to the fair value, or we will write off the loss because of the decline. Okay, so that is how you have to frame the question. What is a current investment? You have to write that. Or what is a long-term investment? You have to write that. Then, because it is a long-term investment, we have to value it using what do you call the principle of long-term investment, valued at cost. But if there is a decline which is other than temporary, then it should be written down to the realizable value. Then accordingly, the investment should be valued at so and so amount. That is what you have to state. Okay, so that is how you will be writing when it comes to the examination. Now we'll take up questions. So for example, this one where it is a core theory testing. An unquoted long-term investment is carried in the books at a cost of 2 lakhs. The published accounts of the unlisted company received in May year 1 showed that the company was incurring cash losses with declining market share, and the long-term investment may not fetch more than 20,000. So we invested at 2 lakhs. It may not fetch more than 20,000. How will you deal with this in preparing financial statement for the year ended 31st March of year 1? Okay, now one thing that you have to understand is the information when we received was in May. Now you have to see whether the financial statements have been approved or not approved. Okay, that is one thing you have to write. Assuming it is not approved, assuming it is not approved, then this becomes an adjusting event. This becomes an adjusting event because we got the financial statements for 31st March of year 1 as on May. So the condition existed on 31st March of year 1 and we got the information in May, hence it is an adjusting event. Now, if it is an adjusting event, what is the thing we will do? We will adjust it. That is the first thing. So that part you will cover first. Then, second part that you need to understand is there is a cash loss, it is not doing good, and the long-term investment may not fetch more than 20,000. Now, if we assume that this investment, if this we assume that this declining in value is other than temporary, then we have to make a provision for diminution in value. 2 lakhs minus 20,000, 1,80,000 should be provided for. But if we assume it is not, if it is temporary decline, then in that case you will continue to show it at 2 lakhs. So that is why you have to give the answer. Okay. Provision for diminution should be made to recognize the decline other than temporary in the value of investment. This is very, very important. Exact same terms if you write, their answers are true. Okay, so that is how we will answer. Then ABC Limited wants to reclassify its investment in accordance with Accounting Standard 13. Decide and state the amount of transfer based on the following information. So you can have current to long term, or you can have long term to current. Both the scenarios are possible. Now, how do we reclassify? Long term to current, lower of cost and carrying amount. Current to long term, lower of cost and fair value. Okay, so that is the amount at which we will be transferring. First, portion of current investment purchased for 20 lakhs to be reclassified as long term as the company has decided to retain them. The market value on the date of balance sheet was 25 lakhs. So what is this current? Current means lower of cost and fair value. What is the cost? 20 lakhs. So we'll transfer it at cost. The market value is 25, which is higher than the cost. Therefore, the transfer should be carried at cost only. But you have to give this theory. This theory is important. Okay. Then another portion of current investment purchased for 15 lakhs to be reclassified as long term. The market value of this investment on the balance sheet date is 6.5. Lower of cost and fair value. Fair value is 6.5. So you will take it to 6.5, balance 8.5 lakhs will be your expense. Certain long-term investment no longer considered for holding purpose to be reclassified as current investment. Original cost of this was 18 lakhs, but is written down to 12 lakhs. So cost 18 lakhs, carrying amount 12 lakhs, so you'll transfer it at 12 lakhs. To transfer at 12. So what about 6 lakhs? 6 lakhs has already been written off to P&L. So there is no treatment for that loss of 6 lakhs. Then Innovative Garments Manufacturing Company invested in the shares of another company on 1st of October at a cost of 2,50,000. It also earlier purchased gold of 4 lakhs and silver of 2 lakhs on 1st of March. Market value on 31st March of the above investment are given below. Shares, gold, silver. Shares is 225, gold is 6 lakhs, and your silver is 3 lakhs 50,000. Okay. Now, what is the question? How above investment will be shown? The screen got interrupted in between. I hope now it is visible. How above investment will be shown in the books of accounts of Innovative Garments Manufacturing Company Limited for the year ended 31st March, as with the provision of Accounting Standard 13 investments. Okay, now what have they done? They have given 3 investments: shares, gold, and silver. Okay, now how do you evaluate shares? You have to check whether it is current or long term. If it is current, what is the cost? Cost of 2,50,000. So if it is current, you'll value it at 12,50,000. Sorry, if it is current, you'll value it at 225, lower of cost and fair value. If it is long term, you'll value it at cost. Okay. Then it purchased gold of 4 lakhs, silver of 2 lakhs, and 1st of March. Market value is as follows. So cost of gold is 4 lakhs and cost of silver is 2 lakhs. Okay. Now here in both the cases, cost is lower than the market value, and hence you will be showing it at cost only. That is the first thing. Okay, that is the first thing. Second thing is, again here, whether it is long term or short term. Now, we can make an assumption it is for long term, or you can make an assumption which is short term. But however, whichever assumption you take, cost is still higher, lower than the market value. You will continue to show it at cost. Okay, so that is how you will do the answer. So that is as far as the principles of accounting standards related question is concerned. Okay, that is how it is done. Now, the second thing is investment account to be prepared. Now, when we talk about investment account to be prepared, please ensure you follow this format. Okay, this format which is easier to use. You'll mention the date, particulars, nominal value or face value, interest, what is the cost, that is one part. Then date, particulars, nominal value, interest, cost. Here, in case of shares, you can have dividend column also. Okay, so you will have date, particulars, face value, interest, cost. Is it mandatory? Not mandatory, but as per the suggested answers, the model solutions, whatever they have given, even when we check papers, all of this information is given. Okay, so for the entire set, you will get marks. So can we write total? Total is, if you want, you can write total also. So interest plus cost, you can write a total column also. You will do it in the horizontal format. Okay, because this will not fit in a single page, right? For each investment, you will prepare a separate investment account. So that is these are the things you have to keep in mind. Now, whenever they give an information of purchase, ensure you add the percentage of brokerage, any other duty and all at the value of the transaction. That is one thing you have to keep in mind. Then, especially with respect to debentures, you have to see if there is any pre-acquisition dividend for interest. For dividend also it will be there, but for interest it will be much higher. In year 1, Messrs. Y Limited issued 12%. Yeah, horizontal means landscape. Vertical is your vertical format, the page, when you take the page. So if I have to just show you this is how normally it would be, right? I don't think it is visible. It is blurred. So the thing is, make it the way you do partnership capital account. It will make examiner's job easier to value the thing. Okay, that is the first thing, right? So here, Messrs. Y Limited issued 12% debentures of 100 each, interest being payable half yearly on 30th September, 31st March. These dates are very important. This is when the company will pay interest. This is when the company will pay interest. On 1st of December, Bull and Bear purchased 10,000 of these debentures at 101 X interest price. X interest means interest has to be computed separately and paid separately. Interest has to be computed separately and paid separately. Also paying brokerage at 1% of X interest amount of the purchase. If nothing is given, this value is the value that is considered for calculating brokerage. So this is the first thing. Now, first thing, when did we purchase? We purchased on 1st of December. When we purchased on 1st of December, first thing that you have to do is which was the last interest paid date. That is what you have to calculate. So here interest is 30th September, 31st March. If I purchase on 1st of December, the latest date is 30th of September. So till 30th of September, the company has paid the interest. Till 30th of September, the company has paid the interest. Now, when I buy on 1st of December, the selling party will ask me interest for full month of October and full month of November. 2 months interest the selling party will ask. Interest based on what? Interest based on 12% at face value. So 12% of 100, 12% of 100 into 2 divided by 12. 2 months interest I have to pay. So this if I do, this will become to 2. This will come to 2 per debenture. This if I multiply by 10,000, that is 10,000 into 2, I get 20,000. I get 20,000. Okay. So this is one thing that we need to understand, that this is the interest value that we will pay separately. Now, if this was given cum interest, let us say 101 cum interest, then from this 101 cum interest, we would have reduced 2 of interest. But here we will say 101 plus 2 of interest. 20,000 is interest. Okay. And brokerage of 1%. So amount paid will be 10,000 into 101%. When they say purchased at 101, purchased at 97, 98 and all of that, that indicates percentage. 10,000 into 101 into 100. This is the face value. Okay. Now when face value is 100, you can directly say 10,000 into 101. Okay. If face value is 1,000, then you have to use 101% into 1,000. If at all there is a face value of 1,000. If face value is 100, you can directly take 101. So this will become, if I have to calculate 10,000 into 101, 1010,000. This is the thing. On this, 1% brokerage is payable. So you add 1% brokerage, that is 10100. Okay, 10100. So the total comes to 1020,100 plus interest 20,000. So that is the total amount paid. Now, when you pass the entry, you will debit the investment cost by the amount paid towards the debenture, and you will debit interest to 20,000. So the actual entry is in investment debit 1020,100, interest debit 20,000 to bank the number. Okay, so that is the first thing you would do. Then, and please keep in mind, in examination sometimes they give you question with multiple transactions, so you have to be very careful in calculating. Okay. On 1st of March, the firm sold all these debentures at 103x interest price, again paying brokerage at 1% of x interest amount. Now what happened? On 1st of March, they sold. Did we get any interest? We did not get any interest. The company will pay us interest on 31st of March. We sold it off on 1st of March. So my selling price will be 10,000 into 103. That is 103,000. Right? This is my selling price. Plus, brokerage. Sales value will reduce brokerage because we will get lesser amount. Minus brokerage 1%, that is 103,000, 10,300. So 10,30,000 minus 10,300, you have 10,19,700. That is towards the sale value of debenture. Please remember, as we pay 2 months interest, we will also ask interest. Sir, how much amount interest we will ask? Last paid date is 30th of September. We are selling it on 1st of March. So we'll ask interest for October, November, December, January, February. Okay, for 5 months. So 5 months interest will be 50,000. 5 months, like we had 2 months interest at 20,000, 5 months interest is 50,000. Okay. Now the difference between the cost 10,20,100 and the selling value 10,19,700, whatever is the difference that we get, that difference will be the P&L balance. Okay. Now here what has happened? We purchased at 10,20,100, we sold at 10,19,700. So there is a loss of 400. There is a loss of 400. Now this is 100% sold. If we had only sold, let us say 400 debentures, we would have calculated gain or loss considering 400 debentures, and balance 600 debentures would be closing balance. Okay. This is the loss. And the balance number in the interest column is the interest. Now this 30,000 is basically, see, we purchased on 1st of December, we sold on 1st of March. This represents 3 months interest. That is how the account gets tallied. Any question here? Let's look at this one. On 1st of April, Mr. Krishnamurthy purchased 1000 equity shares of 100 each in Telco Limited at 120 from a broker who charged 2% brokerage. He incurred 50 paise per 100 as cost of shares transfer stamps. Okay, so basically what it means, 2% brokerage we paid and 0.5% stamp duty we paid. On which value? On the transaction value. On 31st of January, bonus was declared in the ratio of 1:2. 1:2 means 1 for 2. So if I have 1000 equity shares, I'll get 500 bonus shares. Please remember, for bonus, we'll just adjust the number column or the face value column. We will not adjust the value column because the value of investment does not change. Before and after the record date of bonus shares, the shares were quoted at 175 and 90 per share respectively. This change in value because of bonus shares is not relevant for us. What is relevant for us is what is the closing balance? What is the closing balance? On 31st of March, Mr. Krishnamurthy sold bonus shares to a broker who charged 2% brokerage. How much did we sell? We sold 500 shares. Show the investment account in the books of Mr. Krishnamurthy, who held the shares as current assets, and closing value investment shall be made at cost of market, whichever is lower. Even if this information is not given, because we are holding it at current investment, we will value it at cost or market value, whichever is lower. Okay. Now, sir, how to take the market value? Market value, if nothing is given, we can take this number as the market value, that is post the bonus issue. Okay. Now, first, how many shares? 1000. Face value 100. So, to bank, this is the nominal value. Then, how much did we pay? 120. But we paid 120 plus 2% brokerage, 2.4 plus 0.5% stamp. Sorry, 0.5% stamp duty, which is 0.6. So this is 120, 122, 123. 123 per share. Or you can calculate on totality basis also. Totality basis, that is 1000 into 120 plus 2.5%, you get 1,23,000. You get how much? 1,23,000. Okay. So that is the first entry. Then there is no dividend. There is a bonus issue. Now, whenever there is a bonus issue, you will just say to bonus shares, just increase the face value or quantity. So instead of nominal value, you can also have quantity. You can follow that also. You will add here, but amount will be 0. You will not add anything in the amount column. All right. Then on 31st March, Mr. Krishnamurthy sold bonus shares to a broker who charged 2% on brokerage. Now, sir, what value did we sell it at? Now, nothing has been given, so we can assume that we sold it at this number, that is after the bonus issue. So 90 is the sale value. How many shares did we sell? We sold 500. See, we had 1000 shares. We got 500 as bonus. This 500 we sold. This 500 we sold. So 500 into 90, we get 45,000 minus brokerage. See, whenever we are selling, we will reduce the brokerage. Whenever we are buying, we will add the brokerage. Okay. Brokerage at how much? 2%. So 2% of 45,000 is 900. So you get 44,100 as sale value. So you have 44,100 as sale value. Is it clear so far? So far it is simple calculation. Correct. Okay. Now, the most critical element is what is the profit on sale of these shares? What is the profit? Don't think bonus shares is 0. We should not do. After you purchase this bonus share, we have to calculate what is the average cost per share. Average cost per share meaning we paid 1,23,000. With this, we got 1,500 shares. So 123 divided by 1,500, we have 82 per share. This is the cost, average cost. Okay. Now what do we do? Cost of shares sold is equal to 500 into 82. 5 8 is 45 to the 10, 41,000 is the cost sold. 41,000 is the cost sold, and balance 1000 into 82. This is my closing balance. So we'll follow average basis, not FIFO or something. Unless the question mentions it, we'll follow the average basis. Right now, sale value is 44,100. Sorry, sale value is 44,100. Cost of this is 41,000. So 44,100 minus 41,000, when you do, you get 3,100 of profit. That profit you will record on the debit side. Always remember, profit is recorded on the debit side of the investment account and losses are recorded on the credit side of the investment account. So 3,100 is the profit. 3,100 is the profit. Then 82,000 is the closing balance. 82,000 is the closing balance that you have calculated. Your ledger will automatically tally. Okay. These type of questions typically we can expect for 5 marks in the examination. One more thing, the bonus before and after what they have given, that thing we should, not consider as if it is a right issue. One more thing, our closing valuation is at how much? 82. What is the market price? Market price is 90. So because it is less, the cost is less than the market price, we'll continue to show it at cost only. Okay, so this valuation of equity shares for 31st March is also important. If it is lower, let us say, if for example, for whatever reasons, the fair value is only 70,000. So you will record this at 70,000, balance 12,000 will be your loss. Okay, that is one thing you have to keep in mind if it is a current investment. Let's look at this one. On 1st of April of year 1, Rajat has 50,000 equity shares. This is what opening balance of P Limited at a book value of 15 per share, nominal value 10. Book value of 15 means cost is 15, opening balance is 15. He provides you the following further information. On 20th June of year 1, he purchased another 10,000 shares of P Limited at 16 per share. So this is the fresh purchase. That is 10,000 plus into 16. On 1st of August, P Limited issued one equity bonus share for every 6 shares held by the shareholders. Now, please remember, unless the question mentions otherwise, you are entitled to bonus and dividend on all the shares. You are entitled to bonus and dividend on all the shares. So, 10,000 is your purchased, 50,000 is what is your original holding, right? So, 50 plus 10 is 60,000. How many bonus shares? 1 for 6. 1 is to 6. So, into 1 divided by 6, you get 10,000 bonus shares. You get 10,000 bonus shares. On 31st October, the directors announced a right issue which entitles the holder to subscribe to 3 shares for every 7 shares held at 15 per share. Shareholders can transfer the rights in full or part. So, now what is this? Original holding is 10,000, 50,000 is the opening balance, 10,000 is the original holding, bonus issue. You have 60,000. Sorry, my bad. Original opening balance is 50,000 plus 10,000 we purchased. We got 60,000. Then we got 10,000 bonus. This made it 70,000. Now my right entitlement is 3 shares for every 7 shares held. So 70,000 divided by 7 multiplied by 3. Right entitlement is 21,000. Okay. This basic working, you should be able to do it properly. This basic working, you should be able to do properly. Okay. Now, Rajat sold 1/3 of the entitlement to Umang for a consideration of 2 per share. So, out of 21,000, sold 1/3, that is 7,000. Subscribed. Balance will assume we have subscribed 14,000. Okay. So balance brought down 50,000 at 15. So 50 into 15, 7,50,000. To bank account, we purchased 10,000 at 16. So 10,000. 10,000 into 16, 1,60,000. Then bonus issue 10,000. So like what we did, they got bonus issue of 10,000. So I did a mistake here. 70 by 7 into 3. Guys, if I am making any calculation error, it is your duty to know. Responsibility. Yeah, Vishnu had highlighted 30,000. So it is 70 by 7 into 3. I did 7 into 3 wrong. This is 10,000 into 3. This is 30,000. Out of 30,000, I'm doing again. We have 70,000 shares before the rights. Divide by 7 into 3. This has to be 30,000. Thanks, Vishnu. Out of this 30, 1/3 is sold, 10,000, and 2/3, 20,000 is subscribed. By sale of this, whatever amount we get into 2, this is 20,000. This will be transferred to P&L unless the shares issue after the rights have, the share price of the rights have come down. In that case, we can credit it from the cost of shares also. Okay. But here nothing has been given, so we'll take directly this 20,000 to the P&L. We subscribe to the right shares 20,000 into 15, 3 lakhs, and closing balance 90,000 shares of 12 lakh 10,000. Okay. Now, if for example, because of this rights issue, the shares price have fallen, we will credit this to investment account. We'll say by bank 20,000, depending on what is given in the question. This is credited to P&L. Any questions so far? Any confusion in this? This is one of the easier chapters, only that calculations can make it complicated. Also, the wording of the question. The wording of the question, very, very important. Very, very important. The wording and sequence. So, if there is right issue, bonus issue, multiple issues given, you will go in the sequence of what is given in the question. Okay. And unless I'm telling you, unless it is mentioned, every share is entitled for bonus, every share is entitled for right. Okay. Let's look at this one. On 1st of April, Sundar has 25,000 equity shares of X Limited at a book value of 15 per share, nominal value 10. On 20th June, he purchased another 5,000 shares of the company at 16 per share. Similar question. The directors announced a bonus and rights issue. No dividend was payable on these issues. Now here, they have clearly said bonus and rights issue. No dividend was payable on these issues. So if dividend information is given, only will get an original share. Sir, if this statement was not given, then what? Then you will assume every share is entitled to your dividend and bonus and rights. Okay, please keep this in mind. And that is how it works in real life also. That is how it works in real life as well. Okay. Bonus issue 1:6. Date is 16th August. So first you will do the bonus issue. Bonus issue 1:6. First you will give the impact of bonus issue. Then rights basis 3:7. Same. The structure is same. 15 per share. Due date for payment 30th of September. Shareholders were entitled to transfer the rights in full. Accordingly, Sundar sold 1/3 of his entitlement to Sekar for consideration of same. Now, only thing different in this question is dividends for the year 31st March of year 1 at the rate of 20% were declared by X Limited and received by Sundar on 31st of October. When did we get declaration? 31st of March. So if we got the declaration on 31st March itself, on 31st March itself, we can say that it is dividend which is receivable. It is dividend which is receivable, that you have to record it. Okay, that is the first thing you have to keep in mind. Then, dividends for shares acquired by him on 20th June are to be adjusted against this cost of purchase. Okay, so multiple things are there. One, you have opening balance. This dividend, whatever you get, that is how much? 20%. So 25,000 into 20% into 10, whatever you get this number, this 50,000, this will be directly taken to P&L, no problem. Then we purchase something on 20th of June, 5,000 shares at 16. They announce dividend at 20%. So what is the dividend there? Dividend there is 5,000 shares into 10 into 20%. This is 10,000. This is considered to be pre-acquisition dividend. If it is pre-acquisition dividend, we'll reduce it from the cost of investment. Now, what is the entry we pass? Normally, we say bank to dividend. But here we will say bank to investment. Bank to investment. So in the investment account, what you will do, you will credit that 10,000 that you have received as dividend. So what about balance dividend that we have received? The balance dividend that we have received will be taken to P&L directly. 50,000 that we calculated, that will be taken to the P&L directly. Okay. Then on 15th November, so after all of this, after this date, on 15th November, Sundar sold 25,000 shares at a premium of 5%. So technically, there is nothing called premium. The sale price, basically what they mean is, it is 15. Sale price, what they mean is, it is 15. Now, the most important thing here is, we started with how many shares? 25,000 shares. Then we purchased another 5,000 shares. So we have 30,000 shares. Plus we got bonus. Now, what is the bonus that we have received? The bonus count, if you see, the bonus is 1/6. So bonus is 1/6 means 1/6 of 30,000. We got 5,000. This makes it 35,000. This divided by 7. The rights issue is same, no? 3:7, like we had in our other question. Rights issue is 3:7. So 35,000 divided by, not 35,000. We purchased 5,000 again, I guess. We purchased 5,000. So again, my bad here. I'll just redo this. No, correct only. 30,000 plus 5, 35,000. 35,000, the bonus issue is, the rights issue is 3:7. So divide by 7, multiplied by 3, if I do, it becomes 15,000. So the total shares that we have currently, out of this 15,000, we subscribed to 10,000 and we sold 5,000 in the market. So the total number of shares that we have is 45,000. How 45,000? 30 opening plus 5. Not opening 30, 25 plus 5 purchased 30, 30 plus 5 bonus 35, 35 plus 10 that you have subscribed 45. So this is 45,000. Now the most important thing you have to keep in mind is, for calculating average cost, you will take opening cost, whatever you have paid, bonus is 0. Rights issue subscribed cost. So the most important is minus 10,000 of this pre-acquisition dividend. So when you do that, 375 plus 80 plus 150 minus 375, 80, 150 minus 10 divided by 45,000, you get the average cost. You get the average cost. You get the average cost, right? That cost multiplied by 20,000 is the closing balance, and we have sold 25,000 shares. So while calculating profit on sale of 25,000 shares, you will multiply that by 25. Or the easier way to do that is this number 375 plus 80 plus 150 minus 10. You have 5,95,000. This is the cost of 45,000 shares. So 595 divided by 45,000. If I do, I get 13.22. This is the average cost. Closing balance will be 20,000 into 13.22, and the cost of sale will be 25,000 into 13.22. Like this also you can do the calculation. Closing balance information is not given, so the cost will be considered as closing balance. For the shares purchased on 20th June, if the question was silent on pre-acquisition dividend, would we receive the dividend? So what we have to see dividend, this is just for your general understanding also, so that you are aware of how things work in the real life. Generally what happens is, This is 31st of March of year 1, financial year end. Let us say 31st of May is when the financial statements are signed. Somewhere around 30th of September, AGM is held. In the AGM, they declare the dividend. In the AGM, they declare the dividend. They declare. So this is the date of declaration. When they declare the dividend, what they say is, or when they pass the resolution, they mention that the shareholders who hold the shares on, let us say, who are holding the shares on, let us say, 15th of October. Whoever hold the shares as on 15th of October, this is called the record date. You should have the shares as on 15th of October to get the dividend. Whether it is dividend pertaining to previous year, whatever is the date from whichever profit it has come, they will say 15th of October is the record date. So if I hold the shares on 15th of October, I'll get dividend. This happens in real life. Okay. There is no such concept, very rarely you will see that. It can happen only in the private companies where they say that this share will not be entitled to dividend. But generally practice, if you see, because when I'm buying it on 30th of September, I'm assuming the company has earned profit. Or if I'm buying it on 10th of October, I'm also buying because the company had the past profit. You cannot exclude me. But after this record date, subsequent buyers, they will not be entitled to dividend. Okay, they will not be entitled to dividend. So this is the record date. So technically, in the question, if they have not mentioned anything, when was the dividend declared? 31st of October. You will be entitled to dividend on bonus also, on rights also. Okay. Technically, that is how it works. ICI, somehow they have this concept of dividend is not applicable on this, not applicable on that. Generally, that is not how it happens. All right. Now, one question we'll do, which has both cum interest and ex interest. The following information is presented by Mr. Z relating to his holding in 9% central government bonds. Okay, 9% central government bonds. Opening balance, nominal value 1,20,000, cost 118, nominal value of each unit is 100. So they have themselves given that nominal value of each unit is 100 and what is the cost? 120. So when you prepare in the nominal value column, you will write cost 118, the nominal value 120, cost 118. Okay. On 1st of March, he purchased 200 units, ex interest at 98. Means purchased on 1st of March, 200 units at 98 ex interest. So you will add interest to this separately. Sold 500 units ex interest out of original holding at 100. So 500 units of original has been sold. This you will credit. You will also collect interest on this. Purchase 150 units, 98 come interest. Now here what it means is total value paid is 98. Total value paid is 98. And from this we'll remove the interest component and account for it separately. We'll account for it separately, right? Then sold 300 units ex interest at 99 out of original holdings. Okay. Interest dates are 30th September and 31st March. Mr. Z closes books on 31st December. So books are closed on 31st of December. So this opening balance is as on 1st of January. When is the interest paid? 30th of September. So in this opening balance, also, we have the interest component. Okay. And I think I missed to mention that point. If the date of payment of interest is not same as the date of year end, you also need to calculate accrued interest and credit it to the investment account, like in this case. Okay. Now here, opening balance has a cost of 118, 120. That is the opening balance. On which date? On 1st of January. Whereas interest was previously paid on 30th of September. So October, November, December, 3 months interest is accrued. It is lying as an accrued interest in the previous year. So when we open the books, when we do the opening balance, what we'll do is we'll calculate 3-month interest and post it in the interest column. Like the same way, we will have closing balance of interest, right? Now, how much is the interest? 120 into 9% into 3 by 12. So 120 into 9 into 3 by 12, if I do 120 into 9 into 3 by 12, if I do, I get 270. 270, 2700 is the interest. So what happens is when you say to balance brought down, you would say cost 1,20,000, nominal value 1,18,000, and interest column you will say 2,007 because this is the interest income of the previous period. This is the interest income of the previous period. Okay, then that is the first thing. Then on 1st of July, we sold 500, on 1st of March, purchased 200 units, X interest at 98. So 200 into 98 if I do, I paid 19,600 plus I have to pay interest. Interest for till March. So October, November, December, January, February, not March. March, we purchased on 1st. So 5 months. So 5 months, how many units? 200 units. 200 into 9% into 5 by 12 into 100. So if you do 200 into 9 into 5 divided by 12, we get 750. So apart from this, you also pay interest of 750 that you will account for it separately. So let us see. Opening balance, cost, interest, sorry, nominal value, interest, cost. Then 19,600 is we paid plus interest we calculated 750. All right. Then on 1st of July, sold 500 units X interest out of original holding of 500 at 100. Means what? We sold 500 into 100. That is the sale value. This is what? X interest. If it is X interest, we will collect interest also. So interest on this till which date? 1st of July means last interest payment date is March. So April, May, June, 3 months interest. 500 into 100 into 9 into 3 by 12 for 3 months. So 500 into 100 into 9 into 3 by 12, we get 1125. This interest amount will collect along with the sale proceeds. So when we post it, we will say by bank 500 into 100, 50,000. So our entry will be by bank, interest column 1125 and principal column 50,000. Principal column 50,000. Right now, when this transaction happened, there is a profit earned because we sold some number of debentures and there is the cost to that. The difference is profit. Now here if you see the investment account, it would appear as if Mr. Z follows FIFO method. FIFO means what? First in, first out. So we have opening balance of 1200. Current year purchase of 200. We sold 500. When we sold this 500, we sold out of this 1200. So cost that is relevant is 118. Cost that is relevant is 118. Okay. Cost that is relevant is 118. So here by bank sale proceeds of 50,000 that we have received, right? Then we also received 1125 of interest that we have collected, right? Now we have to calculate what is the profit element on this sale. That is the first thing. One more thing, what we missed, on 31st March we'll receive interest. On 31st March we will receive interest. On which all purchases we will receive interest? We will receive interest on the opening balance and whatever we have purchased on 1st of March. So opening balance is 1200 plus this is 200. So total is 1400 into 9% into 6 by 12. So 1400 into 9% into 6 divided by 12, we get 6,300. This is the interest received on the first two transaction. That also you have to keep in mind. Whenever there is an intervening date, we'll get it, post it to interest column, and at the end of the year, the balance will be transferred to P&L. Okay, so this is done. This is done. Now, what is the profit? 1,18,000 is for 1,200. So 118 divided by 1,200. Cost is 98.33. This cost is 98.33. And at what value did we sell? We sold at 100. So what is the profit? Profit is 1.67. Profit is 1.67 per share. 1.67 into 500 if I do, I get 833. That is one way to calculate. Or the other way to calculate is, you can say cost of 500 is equal to 118,123 divided by 1200 into 500, or divided by 1,20,000 into 50,000. Whatever you do, the number will be the same. This is the profit of 833. Cost divided by 1200 into 500, 49,167, sale proceed 50, profit is 833. That profit will transfer to P&L. Sir, can we transfer all the profit at once at the end of the year? You can do that, but the problem is you may miss out. So moment there is a sale transaction, immediately post the profit transaction or loss transaction. Okay. Then on 1st of October, purchase 150 at 98 come interest. It is along with interest. It is along with interest. But the best part here is, or the confusing part here is, we purchased on 1st of October. When did we pay the last interest? We paid the last interest on 30th of September, which means there is no accrued interest. Sir, there is accrued interest of 1 day. No, sir. See, technically what happens is, if you have purchased on 1st of October, you will start getting interest from 1st of October. So, last interest paid date is 30th of September. The next day, if you have purchased, you will not pay anything, or you will not consider anything towards interest. Entire 98 is your cost. Sir, what if we purchased on some other date? So let us say we purchased on 1st of November at 98. Then in that case, what would happen is 100 into 9% into 1 by 12 is the interest component. So 100 into 9% into 1 divided by 12, 0.75 is interest. So out of 98, you would say 0.75 is interest, 97.25 is the principal or the cost. Okay, that is one working you have to keep in mind. Purchase 150 units at 98 come interest, so we'll account for it. Sold 300 units x interest at 98, 99 out of original holdings, 300. So we have 1200, out of 1200 we sold 500, again we sold 300. Same treatment what we did for the previous year, same thing we'll do. One more thing is, between 1st of July and 1st of October, there comes 30th of September, for which also we'll get interest. Now here, we'll get interest on how many shares? 1400 minus 500, only 900. So here, the interest that you have calculated, you will get only on 900 shares. Okay. Then closing balance of investment that you have to calculate, be slightly careful because this is FIFO. You are not doing weighted average. The question has specifically told FIFO, so you have to do FIFO. Now, what is the closing balance of investment? Closing value of investment, if you calculate as per the ledger, you get 75,000 as the nominal value, or 750 as the count. Out of the 750, what you have to see is 1200 minus 500 minus 300. 1200 minus 500 minus 300. 1200 minus 500 minus 300. How much is left? 400 is left. So you will take 400 from the opening balance, and this as it is as per the actual cost. So it will be the closing balance. And then you also need to calculate interest element in the closing balance of number of debentures. Now, how do we calculate that? Closing balance is 750. The last dividend paid was on 30th of September. So October, November, December, 3 months balance, 3 months interest is what you will calculate. Are we clear? See, the pattern of questions are same. Just that we have to be cool in the examination and read the information properly and calculate the working notes properly. Our working note is mandatory because, by using FIFO method, you can do it, no problem. If you can handle that, it is okay. That's not. So what happens is, this if you calculate, right, on the principal side, 1,18,000 plus 19,600, 833, this, all these numbers when you calculate, you will get to the same number. But sometimes working note carries marks for closing stock valuation. Okay. So the time you will spend to verify it mentally, just take 1 minute extra and write a working note. No? Okay, that would be helpful. Because there are marks, 1 mark also matters, right? Okay, so this requires, see, it requires careful calculation. It requires careful calculation, especially when you have multiple transactions happening. If it is a single transaction that is given or a 2 transaction that is given, then all of you will do good. I know, I'm 100% confident on that. Okay, if nothing is mentioned, we'll follow weighted average method. If in this case the question gave FIFO method, so hence we follow the FIFO method, and be very careful of cum interest, X interest, and interest dates. Okay, so just look at the ledger and see how much interest should I receive, and accordingly you will post. Right now, we'll take a 10 minutes, not 10 minutes actually. We'll get back at 11:15, and we'll start up with the next standard, accounting standard 17.